As senior year comes around, we start to worry about college applications, high school transcripts, and standardized tests, and making sure we get accepted to the college of our dreams. But we also have those extra costs that come along with being a senior. All these things eventually add up into a big, huge number. Here's a few lists of things that I've encountered in the first quarter of my senior year. $5 per transcript sent to college. Then we have $30 to $80 per college application. If you need any help, $15 for any calculator. Then we have $35 to $110 for any textbooks needed. $42.50 to $52.50 per SAT or ACT administration. And $300 to $600 for any dual enrollment classes taken in your senior year. This all adds up to a whopping $2,735 fee. Just make sure you keep track. So next up, we have optional fees. The first one, $15 for a senior video copy. Then we have $8 per senior t-shirt. And if you also want a yearbook, $75 to $100 per yearbook. This price varies. And for $75 to maybe $1,000 for any classroom trip. And as senior year comes by, $20 or more per prom ticket. Then we have $75 for a small senior portrait package. Make sure to ask. And for graduation packet, it's $175 or more. Then we have $200 for any semi-wear, prom, tickets, rentals. And just to make sure, we have $15 for a parking permit. Then we have $30 or more for a sport physical. And if you want to be super involved, $5 to $10 for any after-school event. And for AP or any classes, $5 to $15 for certain electives. And for clubs, $3 to $10 for club fees. This also adds up to a whopping $1,467. And like I said, just make sure to keep track. And now to our mandatory fees. We have $60 or more for cap, gown, and tassel. Then we have a $20 senior portrait sitting fee. And we have a $15 Chromebook fee that is mandatory. And then we have a $5 senior class fee. This goes for any class. And as you add up all these fees, $100 is the grand total. After seeing all the senior expenses, if you're like me, you might have some doubts as to how we can manage those needs and wants. And you might have a few questions that need answering. To help with all this, I interviewed Matt Gross at Founders Credit Union, who gave us a few tips and tricks as to how you can manage all this. Here's what Matt Gross had to say.
The first thing I would suggest is sitting down and working on some type of budget. There's different wants for different people. For an example, some people want to drive a BMW, but realistically they can't afford a BMW. So you have to sit down and know your budgets to determine what wants and needs are. I can't stress enough the importance of being in the habit of saving money. The more money you can save, the younger you are, the better off you'll be able to afford things in the future. Budgeting is important. You've got to know how much is going out, how much is coming in. If you have too much going out, not enough coming in, you're going to be in trouble. If you have more coming in than going out, then savings is a little easier. But starting early is the key to any type of savings and making it a habit. The difference between a credit union and a bank. Credit unions are not-for-profit, banks are for-profit. Credit unions have members, not customers. Banks have customers. Members at a credit union are actually part owners of their credit union. So you actually have a stake in the how the credit unions operate. By us being a nonprofit, we actually do not have to pay the taxes that banks have to pay. We pass that savings off to our members in the forms of lower rates on loans, better rates on savings accounts, different types of products that we may offer that a bank may not offer in a different way. Banks being for-profit are there for their stockholders. They're strictly there to make money for their stockholders so they can pay them the profits. So that's the biggest difference between the two. We're here for more of the individuals. Banks are usually more for corporations. At the credit union, everybody has a savings account. That opens their membership up. So you can always start with a savings account. The younger you are, the better off, the more money hopefully you can save. If you're under 18, it does require somebody over 18 to sign on that with you, because you can't legally sign a contract until you're 18. So usually a parent or guardian is going to come in and open it with you. Me personally, when my daughter got to where she was driving, I actually opened up a checking account with her, a membership at the credit union, so she was able to have a debit card. Again, that was for emergencies and things like that, and I tried to teach her how to work her checking account, how to keep up with her balances. So my suggestion for any high schooler would be to have a savings and a checking account if they can handle it. And you do have to be careful with checking accounts with overdrawing them and getting charged fees that you don't want to get charged. So it just depends on the situation and the parent and guardian sitting down with you and going over it. But at a minimum, a savings account, and maybe if you're driving, you may want to be looking at a checking account also. Credit's very important. Everything is scored nowadays. The higher the score, the better off you are. The reason you want high scores is everything's cheaper. For example, at my credit union, if you borrow money, say on a personal loan, the rates can range anywhere from 8.9% up to 18%, depending on what your credit score is. So the higher the score, the better interest rate you're going to get, the less interest you're going to pay, which is going to save you money. Very important when it comes to a mortgage. You want the lowest rate you can, because when you're borrowing a lot of money, the lower the rate, the more you can afford, and the less you're paying back in interest. Usually for a high schooler, it starts with somebody co-signing for you for a loan. Usually a parent or guardian may come in and co-sign for you to get you started. And once you get started, as the months go by and the years go by, you won't need that co-signer as long as you're doing the things you need to do to pay your bills on time. But that's normally the way people get started with credit, is somebody co-signs for them. Say for a car loan, they may a parent may co-sign for them to get their first car, and then after that, you pay on that, pay it off. You should need to the co-signer again. Hopefully, you should be able to build your credit from there. So again, it's a month to month, year to year, decade after decade for most of us. Buying houses is expensive. Buying cars is expensive. The higher your score, the better rates you're going to get, and it's going to save you money over your lifetime. The earlier you start saving, the less it takes each month to save. For an example, if you have something you want to save for, a vacation, a down payment for a car, in your case, maybe you have senior expenses that are coming up your senior year that could range anywhere from $1,000, $2,000, just depends on if you take the class trip, buy a school ring, your cap and gown. There's certain expenses are coming. The earlier you start, the cheaper it is. For example, if you start as a freshman, it may only take $25 a month to save enough money to pay all your senior expenses. If you wait till your junior year, it could be $75 or $100 a month that you have to save. If you haven't done it at all and it's your senior year, guess what? You're going to your parents and having to tell them what the expenses are. So the earlier you start, the easier it is to save the money. The biggest reason is it's safe. You put your money in a bank and it can't be taken out except by you. So you don't have to worry about it getting stolen. If you put it in your backyard, it could get stolen or lost, so you don't want to do that. It earns interest when you put it in the bank, so that's always a benefit. We're paying you to put the money in there to keep it. When I say it's safe, the FDIC for banks, NCUA for credit unions insures your money up to $250,000 per account. So up to $250,000, if the bank or credit union was to fail and go out of business, the government guarantees that money. So that's the biggest reason you want it in the bank. Plus, putting it in the bank, again, establishes those habits, the habits of saving. Every time you get paid, I encourage people to put a little bit of money back towards savings, put it back towards a rainy day.
Now that Matt Gross has clarified the process of managing my senior year, I guess I feel more confident in, managing it. Guess I have to start buying fewer of these. I'm Jacob with DWTV.